Good afternoon, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you again today for our weekly wrap-up. This is a nice Tuesday edition of our weekly wrap-up. Hope everyone had a wonderful holiday weekend, and we're back to business today. Graham, what can you tell us about what went on in the market this past week?
Yeah, thank you, Stacy. Thanks for our listeners jumping on the call. I think it was all about the labor market last week. I think we were showing maybe some early signs, again, early, of maybe some softening, and that's what we want to see. Remember, I've been talking all along is that we want to see some softening in these labor numbers. We want to see some softening in these economic numbers. So maybe the Fed doesn't have to be as aggressive in terms of raising interest rates or keeping them higher for longer. So that being said, let's look at some of the job numbers. If we look at job openings compared to the quit rate, we were looking at job openings about 8.8 million. That was below expected of 9.5. If we go over and look at job gains, they were up about 177,000, but that was below the expected of 194,000 and well below July's of 324,000. We go over and look at the ADP report, and they were highlighting some softening wage growth. If we look at job stayers, they saw about a 5.9% year-over-year pay increase. Now, that's the slowest since October of 21. If we go over and look at for job changers, their pay growth decelerated about 9.5%, and that was the lowest since July of 21. So across the board, we're seeing things coming down, and that translated into an unemployment rate that ticked up from about 3.5% to 3.8. Now, that's still really good unemployment rate, right? I mean, that's getting on the verge of perfection. So we still got some room to go. That's why I'm saying early, but that could at least prompt the Fed to maybe not be as aggressive, maybe not hike in this September, and I think that's buoying the markets. So if we look at what did the Dow Jones Industrial do last week, it was up about 1.4%. The S&P was up about 2.5%. NASDAQ was up about 3.2%. So internationally, they participated as well, up about on average about 2.5%. If we look at the 10-year Treasury yields, that ticked down about 0.1%, but oil was the real leader. It was up 7.6%. So that's been the leader of late. It continued to be. If we just looked at bonds in general, they ticked up about 0.2. So all in all, positive news, even though it's negative news in terms of maybe the Fed doesn't have to be as aggressive for as long.
Okay. Well, Graham, you mentioned that softening of the labor market. Can you explain how that really equates to higher equity markets?
Yeah, let's think about this. Let's think about the Fed interest rates, right? So when they're raising interest rate, borrowing cost increase, right? So companies that derive profits or revenues, maybe off a structure of loans, or these tech companies that have earnings in the future, it's going to hurt their profits and revenues, with rates being so high, along with some other industries. And that will flow through to the balance sheet, lower profits and revenues, can negatively affect stock prices, right? So if rates maybe don't have to stay up as high for as long, or not, maybe just don't go up as much, you can probably gather how that could help. Now, if we flip over to the bond market or the fixed income market, think about it. If the Fed's not raising rates, that might open the avenue for intermediate and long-term bonds to start to participate, because you're not having the pressure on bond values, right? And maybe people leave the short term of the curve and maybe go a little bit longer out. So I think it could really help out both sides. And I think that's why generally across the board, it was a much better market last week.
All right. What about the international market? Is there anything of note there?
Not a lot. Still stubbornly high inflation generally, but you're looking at China because they're so big and they consume so much, and all in all, they're just really struggling to grow. The government's trying to pump as much stimulus as they can into the system, but you got bankruptcies, you have real demand issues, you have really high 20+% unemployment rate for the youth over there. I don't even think they're going to report it anymore because it's just so high and unusual. So they're struggling a bit.
All right. Well, thank you so much for
Yep.
that information.
You
And
got it.
thank you again to all our viewers for joining us today. We look forward to seeing you again next week on our weekly wrap up. And until then, have a great week and take care. Thanks.
Take care.